Is this chart of Roku giving us a bearish setup? Over the next few minutes, I'm going to walk you through how we take this chart pattern, identify the trade, and move on over to the trade page and identify the best option position that's going to give you the most profit potential with limited risk. My name is Mike Rixey. I'm one of the options instructors at Netpicks, and I want to walk you through an example here because you really want to be set up for long-term success in both bullish and bearish markets. If we take a look at this 130-minute chart of Roku, I'm looking for a position that could potentially last for 3 to 20 days. That's what we classify as swing trade. And you'll notice on my chart, I have all the colored dots. The magenta dots here on my chart outline this bullish trade. It gives me an exact entry point, 2 target levels down below, a stop up above. The point of this video is not to walk you through what's going into those dots. I want to walk you through how we're going to take this setup and apply it on the trade page and identify the best option position that's going to give us the best odds of success over time. Now, I don't care if it's this system, if you have your own system, your own set of indicators that you use to identify a bullish or a bearish pattern, that's perfectly fine. But it is crucial to have that in place. I see too many retail traders right now just winging it. Right? They're basing their trading decisions off of what they're hearing on social media, on CNBC, Fox Business, Bloomberg. They're getting this tip from a friend with no basis for the trade. If you're going off of somebody else's research, you're going to be left overreacting to every little move back and forth. The minute the trade goes in your favor, you're going to want to book the profit. The minute the trade goes against you, you're going to want to limit the damage and take the trade off. Instead of basing your decisions off of the technicals and the price patterns on the chart. You're not going to hear us at Netpicks talking about a lot of fundamentals. We're not talking about long-term, income statements, balance sheets, product lines. We're basing our decisions off of technicals. And this pattern gave us a bearish setup. Again, I don't care if the market moves up or down. I'm saying over the next 3 to 20 days, I'm just looking for a pullback to potentially play. So once that entry point is touched, that gives me the green light to put my bearish position on. That's where I go in, I buy the long put. Once I'm in the trade, I already have my 2 target levels down below and my stop up above. I know exactly where to get out before I ever put the trade on, right? We want to plan our trade and trade our plan. It's very crucial and it's often overlooked by many retail traders. Now, a second big mistake that is made by retail traders. You might look at this chart and say, okay, I see the bearish trade there. Let's go over to the trade page and let's go out to the weekly options that expire next week. And let's go to the deep out of the money puts. Let's go to the 93 puts. They're trading for 60 cents. It's a cheap bearish bet, right? 60 bucks. The problem is those options are cheap for a reason. It's a very low quality position. I get it. It's a cheap bet. If you've got limited capital, you want to limit the risk. I understand that. But long term, you want to be able to stack the numbers in your favor. I would much rather pay a higher price and get a higher quality position, a position that's going to better set me up for success. What does that look like? For our swing trades, we prefer to go to the options that have closer to 40 days left. Look at these 42-day options. A lot of times people shy away from these because they think if I put the position on, I've got to hold the trade for 35, 40 days. You don't have to. In many cases, we're still able to get out in just a few days. I've had trades here just recently where I open them with 40 days left to expiration. I'm in and out in 3 days. Right? So by going out further in time, we're able to get a higher quality position because we're limiting the time decay. Every day that you hold an option, that option is losing value from that time decay. And the closer you get to expiration, that time decay picks up. That's why those weekly options can be so difficult. When you put on a cheap bet with a cheap out of the money weekly option, you need everything to go right perfectly. Now, it could work, right? I'm not disputing the fact that those types of positions can work at times. But does it set you up for long-term success? Over a whole stretch of 50 trades, does that approach work? What you're going to find is it oftentimes doesn't. I would rather put on a position that's going to give me a much higher probability of success, where I don't need everything to go right perfectly. All right, so if I go out to the 42-day options here, and again, let's quickly go back over to the chart. Our entry point is at 185. That's the value of this dot right here. So I want to go over to the trade page and let's go ahead and take a look. The 100 strike, that's the at the money put. These are trading for over $600 per contract. Much more expensive, right? But I'm getting a higher quality position. Now I've got 42 days for that stock to sell off. I don't need it to move immediately. I would like it to, but it doesn't have to. With a weekly option, you better believe that thing's got to move in your favor quickly. That time decay is going to add up very rapidly. With this one here, if it doesn't move, we just kind of chop sideways for a few days before it starts to move in our favor, I'm okay with that because the time decay is far less significant. All right. So in this case, I'm tying up around $640 per contract. Notice the volume and open interest here. 103 contracts have traded today. 322 contracts of open interest. What I typically like to look for in the open interest number, I want to see 30 times the number of contracts that I'm looking to trade. If I'm trying to buy an individual contract, I want to see 30 contracts of open interest. If I'm trading 10 contracts, I want to see 300 contracts of open interest. The thought process there is the better the liquidity, the better chance I have getting filled quickly and at good pricing. I want to see enough liquidity there where the bid-ask prices are tight. I can get in and out whenever I want at a good price, where I'm not giving up a lot on that price just to get in or out. All right, so again, we need a chart pattern. Right? We need a system set up. For us, I just showed you, we have an exact system that we follow on every trade that we take. If you've got your own system in place, great. Certainly you can go that route. The next step is for a swing trade where you're anticipating a 3 to 20 day hold. I recommend going out close to 40 days. I don't care if it's a weekly option, as long as you're going out a number of weeks, right? So we like to be as close to 40 days as possible. And then ideally, we're going to go to the at the money strike or slightly in the money. Okay. And that's how we structure our trades. Once we're in the position, we follow the roadmap on our chart. We get out when a target or stop is hit. That way, I'm not overreacting. If the trade goes slightly underwater on me right away, I'm not overly concerned with that, right? Because I know if I go back over to the chart, if we haven't hit this stop up here, it's not time for me to get out. The chart pattern is still valid. And in this market, when volatility picks up, it's really easy to get swayed in the wind, right? Because every little move back and forth, you're saying, oh, should I get out? Because I have that roadmap in place, I don't get out until a target or a stop is hit. We're going to have winners and losers. That's part of trading. So if I use proper risk, keep that risk small. Keep that risk in that 2 to 5% range. So many retail traders are just swinging for the fences right now. What I want to do is keep that risk small. So if I do have a losing trade, which is inevitable, it's going to happen, it's not going to leave me in a large drawdown. It's not going to wipe out an account. It's just a bump in the road where I can get back on track, take another trade, and let the numbers work out in my favor long term. If you can do that, you will be so much better off than most retail traders out there. Swinging for the fences, it's fun when it works. It gets painful in a hurry when it doesn't. So just be very cautious, track that risk. Now, let's take a look at another one. If you take a look at NVIDIA, here's how this whole thing plays out in real time from start to finish. I had my setup right here. This is my red dots. This is my trend trade. That's set up on the downside. Again, I don't care if you're using this system or another system. It gave me a bearish outlook. The entry point was touched, and immediately it moved against me. If I don't have a system in place, I'm probably saying I got to get out. The trade's not going to work. I want to limit the damage, take a smaller loss. And what a mistake that would have been, right? Because after rallying higher here for a day, it rolled right back over to the downside, and we were out at full target. We hit our second dot here, closed it out, booked a nice return. And oftentimes with these types of directional trades, we're looking at between 50 and 150% returns in a matter of days. If I take a look at the timestamp, when this trade triggered in, it triggered in on November 5, and it closed out on November 6. We were in and out in 24 hours. So I went out 40 days just in case we didn't get a quick move like this, just in case it took a little bit longer than expected. I had the benefit of more time on my side, so the time decay is not going to crush me. And I'm in and out booking a 50 to 100% return, in and out overnight, book the profit, move on to the next trade. All right, so just because we go out 40 days does not mean we have to hold for 40 days. We can get out whenever we want. In this case, we book the profit overnight, we move on to the next trade. Really, really powerful. In the months ahead, I personally believe it's going to be crucial to have a system that gives you both bullish and bearish trades. And it's going to be crucial to have a specific rule set in place where you know exactly what option to buy, when to get in, when to get out. Very, very important. So I highly recommend that you work towards getting those things in place. If you need help with that process, feel free to reach out. You can post a comment on the video, or you can email us info@netpicks.com. More than willing to help out there. And then also click the like and subscribe button if you found this beneficial. We will be getting future videos out here to help you with a variety of different topics. And on that note, if you do have any topics that you would like more details on or need some help with, let us know. We'd be more than willing to get some additional videos out on those topics. So I'm going to wrap this video up here. I'll be back with you guys shortly with our next video.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review Netpicks' full risk disclaimer and privacy policy.